Toomey is back with us. Good to see you, especially during these times. I mean, you've been negative. You've shared that consistent view with us and our viewers for months. Did the events of the last week make you more so?
Yeah, I think so. I think from our standpoint, we've been pretty patient in our defensive position. We watched rates go higher. We saw the multiple contract, and we started to see that flow into that negativity with regards to earnings. Earnings have come down about 11%. So we think that started, but this operates in long lags. So we have been a little bit antsy with regards to the fact that this has gone a little bit longer, and we think there's a reason for it, right? The reason has been there was so much liquidity put into the system. There were these additional facilities put in place which kind of elongated that liquidity in these businesses where they didn't really have that judgment day. And I think we're really starting to see all of that work the Fed do come to fruition.
So what does that mean then for where, if you're a little more net negative than you were before, where do you think stocks are going then from here?
You know, I think what I would say is we're not at the end, we're at the beginning of the end. So what we're seeing here is a situation where...
The beginning of the end of the pullback? Or the beginning of the end of what?
The beginning of the end of where we can start getting a little bit more excited about putting money to work.
Okay.
I think what we're seeing is the market is realizing that all of that activity that the Fed has put in such a quick fashion is really creating breakage in the system. And so we saw that specifically within the banks, which we think are the things that are providing the liquidity and the acceleration with regards to growth. And as they start to have problems, we start to think that that'll manifest itself in other places within the economy.
So that leads me to the Fed, right? What do you think the Fed's going to do next week? I almost don't care like what you think they should do. What do you think they're going to do? Because that's ultimately what matters. We all have opinions. They don't matter.
So I'll answer it in two ways. So the first thing is I think right now the market's like a coin flip, whether it's 25 or 0. I think in reality it doesn't really matter. I think the damage is done. This is the situation where the guy at the bar has eight shots of tequila, and you know what? Like having a bunch of coffee or stopping to drink the tequila doesn't matter. The damage is done. We're going to start to see breakage in the economy, and I think despite the fact that even if the Fed pauses, what has happened, the damage has already been done.
But then, well, it has to run its course. I mean, what reverses if they stop, if they don't hike anymore? Doesn't that lessen the damage? Even if some of it's already been done, it doesn't take the next step of making it worse.
No, because I think what we'll start to see is we'll start to see some real damage within underlying businesses themselves. So some of these businesses that really shouldn't be operating at a level where the cost of funds is at this level have to start to come down in value and have to start going out of business. And so we started to see some of these people that were offsides getting caught offsides, and I think we're going to see more of it. You never see a situation where you have this type of breakage in isolation. It's something that's going to fester throughout the rest of the economy. And so for that reason, I think you still need to be defensive. You still need to sit on cash, and you don't want to be aggressive with regards to adding equity exposure.
Let me just let everybody know that the official release of the Faber reporting is now out. That consortium of banks, really what it is, all of the big names on Wall Street, plus the likes of BNY Mellon and PNC, State Street, Truist, U.S. Bank, and again, along with all of the heavyweights. And you can see on the screen here the amount of money. We're talking about uninsured deposits totaling $30 billion into First Republic, trying to at least, give a little bit of a rescue here and ease some of the concerns, soothe the markets, however you want to characterize it. Now that the release is out, the stock is back on the move higher. If we can show an intraday of First Republic, when news of this broke with David, the stock obviously took a big leap up. Then it dipped negative for just a second, or right on the line, and it's on the way back up by some 12%. So we'll keep our eyes there. There's nothing to say, by the way, that there's more, that there are other banks that are going to somehow have a major problem.
No, that's pure speculation. I think from our standpoint, it just demonstrates the fact that there are problems within the economy that are starting to manifest themselves. And some of those we can anticipate. So these are businesses that are dependent on liquidity. These are businesses that are running out of money. These are businesses that are trading at higher multiples. Those are the places that we think are going to have the most problems. But I think the fact of the matter is that we don't want to speculate. We want to talk specifically about facts. And the facts banks are, the Fed's raised rates dramatically. Banks are going to be raising their credit standards. Liquidity is going to be drying up, and that's going to be negative for equities.
So you want to be then more in cash than you even have been in the past, which, I mean, you've had the most cash, I think, than you've ever had.
That's right. So I think we're pretty happy with where we're positioned. We're pretty happy that the market is coming to us, and we're looking where the opportunities are to deploy that cash.
Your pillow, I mean, your head gets comfortable on the pillow at night. I hear you. What turns you more aggressive? What's the one thing you're looking for?
Real pain in the market. The market coming down significantly, where values, we think, prices are more equipped to the values that we put on them. So I'm thinking, probably 10 to 20%, we should start looking to put money into work. That's kind of 3,600s where we start looking.
You think we could get another 20%?
I do.
Well, all right, well, we'll see. We'll talk to you.
Okay.
Again, I know we will. That's Chris Toomey.